Hier ist die neue Folge der Ökonomie-Videos.
Welcome to The Explainer. Today, we're taking on a topic that's, well, it's everywhere. It moves trillions of dollars around the globe every single day. But for most of us, it kind of feels like a big black box. So today, we're going to pry that box open and explain the financial system.
All right, so let's start with a really simple question. Let's say you've been working hard. You've managed to put some money aside. Now, you want to keep it safe, for sure, but you'd also love for it to grow a little, right? I mean, anything's better than just letting it lose value under the mattress. Okay, now picture the other side of this. Think about a company. They have this incredible idea for a new factory. It's a huge project that could create jobs, make amazing new things, but it costs a ton of money up front. And they might not see a real profit on it for, say, a decade.
So you've got this person with a small pot of savings and this company that needs a giant pile of cash for a really long time. How in the world do you connect them? Well, that connection, that bridge between the two, that is the financial system. And that's what we're breaking down today. See, at its very core, the system is designed to solve one single fundamental economic problem. You have savers on one side and borrowers, or what we could call investors, on the other. And the thing is, their needs are almost complete opposites. Let's just look at how different they are. You, the saver, you're probably putting away a relatively small amount. You want to be able to get your money out pretty quick, just in case. And above all, you really don't want to lose it. But the borrower, they need a massive amount of money for a super long time, for a project that is, let's be honest, pretty risky. It's a total mismatch.
So how does the system possibly bridge that huge gap? Well, it all comes down to three essential jobs. You can think of these as the financial system's, its core mission. And here they are. We've got aggregation, maturity transformation, and risk transformation. These three big ideas are basically the engine that makes this whole thing go. So let's dive into what each one of these actually means.
First step is aggregation. And this one's pretty straightforward. The system takes all those little bits of savings from thousands, maybe millions of people, and it pulls them all together, it bundles them up into one giant pot of capital that's finally big enough to fund that huge factory project. Problem one, the size problem, solved.
Next, you have maturity transformation. Now this tackles that time problem. Remember, you might want your money back tomorrow, but that business needs the loan for 20 or 30 years. The system acts like a buffer. It manages to give savers that short-term, on-demand access they want, while still giving borrowers the long-term capital they desperately need. It's a neat trick.
And the third, and maybe the most important job, is risk transformation. Savers want their money back, period. They want as close to a guarantee as possible. But that big factory, it might fail. So the financial system has to step in, absorb that risk, and spread it out so that one failed loan doesn't completely destroy any one person's life savings. And this quote from our source material really nails the central tension here. It says, savers want their money back, but they have to accept the risk that borrowers can't always pay. The entire system is basically a giant, complex machine built to manage that one unavoidable fact. Okay, so we get it. The system has three main jobs to do. But how does it actually do them? Well, it turns out there are two main ways to build a financial system. Two different blueprints. You can think of these as the bank-based path and the market-based path. Now, in reality, most economies today are some kind of mix of the two, but they really do represent two totally different philosophies on how to connect savers and borrowers. In a purely bank-based system, it's pretty simple. The bank is king. It's the central hub. You deposit your savings with the bank, and the bank does all the hard work. It pools the money, it manages the timelines, it figures out the risk, and it makes the loan. All three jobs, all done right there under one roof.
Now, a market-based system, this is where things get really interesting. It basically unbundles those three jobs and gives each one to a different specialized market. Aggregation, that pooling of money, that happens in what's called the primary market, where a company issues things like stocks or bonds.
Maturity transformation happens in the secondary market. Think of a stock exchange, where you can sell your stock to someone else whenever you want. And that tricky risk transformation, that's handled in the derivatives market, where risk itself can be bought, sold, and insured. So, let's put these two blueprints side by side. How do they really stack up against each other? This is where you can start to see the huge differences in how they operate.
Historically, there was a pretty clear divide. Our source material points out that countries like the US and the UK really led the charge toward market-based systems, especially starting in the 70s and 80s. Meanwhile, places in continental Europe traditionally relied much more heavily on their banks. Now, those lines have blurred a lot since then, but that core difference is still incredibly important. This table really just lays out the trade-offs perfectly. Let's just walk through a couple of these. Take information. In a bank system, it's private. The bank does its homework and the loan terms are between them and the borrower. But in a market system, the information has to be public through things like balance sheets and stock prices. Or what about lending limits? A single bank is limited by how much cash it has on hand. But a market can tap into the entire global capital market. That's a huge difference. And that, in turn, changes what the government worries about, from protecting your bank deposit to making sure the markets are transparent and fair for investors.
Okay, look, I get that this can all feel a little abstract, a bit theoretical. But which of these blueprints a country uses has a really direct and honestly a pretty major impact on your financial life. So here's the bottom line. Here's why this actually matters to you. The design of the financial system around you really does shape everything. It decides how your personal savings get put to work in the economy. It affects the cost and even the availability of a loan you might need for a house or a car. It defines how much you get to know about your own investments, and it changes whether you participate in all this indirectly through a bank or directly through the markets. So after all that, which system is actually better? Well, our source material doesn't pick a winner. And that's because each system has its own unique set of strengths and weaknesses when you think about things like economic stability, efficiency, and innovation. And that leaves us with one final thought to chew on. Now that you know the blueprints and the trade-offs, which system do you think does a better job of serving savers, borrowers, and the economy as a whole?